have about risk. So again, here's a semi-annual bond. It's $1,000 par value, $1,000, 7 years to maturity, has a 9% coupon rate, and the price is $1,080. What's the yield to maturity on this particular bond? So let's go and do that example, right? So we have $1,000. Let me kind of go back again. It's 7 years and 9%, so there's 9%. It's 7 years, right? The required return, we don't need the required return here. But we can see what? If the bond has a price of $1,080.55, that's what we had here, $1,080.55, the bond yield to maturity ultimately is 7.48%. Is that the right answer? Let's hope it is. If we put 7.48% here, if the required return and the yield is the same, we should ultimately get the value, and there it is, $1,080.56. So we have the correct value here. Okay? So that's the yield to maturity is 7.48%. We've been talking about bond price behavior. If a bond is selling at less than its face value, we say it's selling at a discount. If it's selling at more than its face value, we say it's selling at a premium. So we want to discuss how bond prices ultimately change with respect to changes in interest, changes in time. So we can look at this another way, right? If it's selling at a premium, typically the coupon is greater than the yield to maturity. And this is sort of a way of kind of think about why this would actually be. I mean, the coupons rate's what you get today to spend. If you're going to get more today to spend than what you're going to earn on average over time, you would like that and you'd be willing to pay for that. So you'd be willing to pay a little bit more for the premium. But if it's not willing to pay you today or this year on the average what you're going to get over time for holding to maturity, you're obviously not as happy with that. You might still want to buy it, but you're not going to pay the same price. You'd be willing to pay a lower price for that. So again, holding all other things constant, a bond yield to maturity should not change over time. Holding all other things constant, though, the price of discount or bond is going to change, though, and it's going to move towards par value. So in the end, when a bond matures, it's worth the $1,000 that's on the certificate. So if you buy it at a discount, the value is going to go up. And if you buy it at a premium, the value is going to go down. So again, it says here, if the bond yield to maturity hasn't changed, then the internal rate of return for of an investment equals its yield to maturity, even if you sell the bond early. So essentially it just says, look, once you buy it, right, the return you're going to get is the same regardless of when you sell the bond or if you hold it to maturity. So the return doesn't change once you purchase the investment. So here's our effect on time. If you go out 30 years, here's the par value. Everything ultimately has to equate or end up having the same value. So it'd be $100 or 100%, which is the par value. I think I'd like to take another little example of this because it kind of gives us a little bit more of an idea of what's actually going on with respect to with these prices. So let's just take this bond. 12% is the coupon, 10% is the return, and time is 10. So if we do this, right, we got 12% is the coupon, 10% is the required return, and it's 10 years. And as you can see here, we have $1,122 is the value. That's what we have right here. We know that's what we say it's selling at a premium. But what if we change the cash flow? So let's think about this before we get there. If we reduce the cash flow, what should happen to the value of the asset? Well, we'll work our way through this. The cash flow is what we use to calculate value. So if you have less cash flow, you're going to have less value. So if we change that to 8%, we see that goes to $877.11. So we have these three bonds. And again, if we just plug the 10 in the middle here, again, make that 10. So the, oops, I'm sorry, it's the wrong one. Make the coupon 10. If the yield to mature, if the required return and the coupon are the same, obviously it sells at a premium. So let's kind of go back up here again. 8% is the coupon. That's $877. What happens if we pay $877 for this bond? What will the yield to maturity be if we actually pay the price? Well, if you actually pay the price of $877, this bond is worth 10%. So let's kind of go to the next slide. So if you pay $877, the bond ultimately sells for $1,000, and you'll earn 10% over this time frame. But when you buy a bond, what type of returns do you receive? Well, there's two of them. You get a coupon, which is a current cash flow, but you also get capital gains. So for this bond, you're going to get a 10% return. That part of that comes from the positive income from interest, and the other comes from the positive capital gains over time. That makes, hopefully that makes a little bit of sense. So now let's go back to the first bond. It had a 12% coupon. Remember, it had a value of $11.22. But what happens if we pay $11.22? What's the yield to maturity on this bond? And again, you can see essentially it's 10%. So this next bond, $11.22, if you buy that, you also get 10%. How do you get that 10%? Well, the coupon is positive, but you're guaranteed to get a loss on this investment. So let's kind of step back and think about this. Why would you ever, ahead of time, buy something that you knew was going to lose money? And I know what a lot of people automatically go, well, you want to do that so you can offset taxes. That is not true. The only time you ever offset capital gains with losses is when you made a mistake. You don't plan to lose money so that you can reduce the tax burden that you have. And here's really the point that I'm driving at here is people don't buy bonds the same way they buy stocks. People buy stocks to watch the price go up and down. They buy bonds for the cash flow. This premium bond has a higher cash flow than this one. People are willing to pay more to get that cash flow. They don't really care where the price goes because at the end, everybody gets $1,000. So at this end, in 10 years, both these investors get $1,000 and they want to reinvest that. They're going to reinvest it in bonds again, and of course they'll reinvest it at whatever bonds they can get 10 years from now. So the cash flow stream is what drives most people towards investing in bonds. And it's the consistency, it's the certainty of that cash flow stream that people are most interested in. We already talked about this a couple of times. We'll have to repeat it a couple of times, obviously. There's an inverse relationship between interest rates and bond prices. So if interest rates and bond yields rise, that must mean that prices have to fall. So let's talk about some different kinds of returns, some additional return numbers. There's typically two that we would like to talk about. The first one's something called a yield to call. Yield to call is a function of refinancing. The technical corporate finance term for this and the bond trading term for this, it's called refunding. So if the company wants to refinance its debt, just like when you want to refinance your house, you have to go out and borrow money to pay off the old debt. So this is that refunding. So what price do you have to pay to get this old debt? Well, there's a yield premium that's stated in this callable debt. And typically it's the principal plus 1 year's interest. So now let's go back here and think about this. As bond prices are going up, right? As interest goes up, what ultimately happens to the price? So let's look at this bond. I'm going to talk about interest rates. When interest rates are rising, if it goes from 10 to 12%, we see that the bond price goes down. But when interest rates are falling, which is obviously when people want to refinance, if it goes down to 7, we now see, look, the value of this bond is $13.51. Well, the call premium is going to be the value of the par value plus the interest rate. That's $1,120. So what happens is that there comes a point in time when interest rates fall far enough, it's cheaper for a company to buy this debt back. They'd pay less money than if they ultimately just let it mature and pay at the end. So it's not only are they getting a lower interest rate, but they're buying back the debt cheaper than what the market price is. The realized yield to maturity is just a mechanism we could put in place to say, look, it's a 30-year bond, but I really only want to invest for 10 years. So what will this bond price be at the end of 10 years? Well, if you think about it, how could you possibly know what the bond price is going to be in 10 years? Well, maybe we can know something about interest rates in 10 years. If you have a picture of what the interest rates will be 10 years from now, maybe we can forecast what the bond's yield to maturity will be. We'll talk about how this might work here just in a little bit, right? So we'll talk about that formula. So in this example, we say, look, in 10 years, the expected price of this bond, again, it's a different bond, so you have a 9% coupon, 10% the required return. It's selling for $900. So we'd like to buy this bond. It has a yield to maturity of 10.19. If we only hold it for 10 years, and we expect its price to be $10.98 in 10 years, the realized yield to maturity is 11.3%. Again, better than the required return. But if it has a call to premium, if they call it in 5 years for $10.90, that actually has a yield to call of 13.24%. So, how can I use this information? Well, if I can forecast interest rates, if I think interest rates are going to fall in the future, it's quite possible that I could actually get a higher rate of return if the company calls. So maybe I'm hoping that interest rates fall dramatically so that the value of this goes up above $10.90 between now and 5 years from now. Interest rate